So I'm gonna present you the steps required to perform regression analysis and to estimate beta of a stock. I have chosen Tesla, but whatever stock you wanna find, you can simply write down here the ticker symbol of that company. And once you have the information, once you click on search, you have to the left-hand side those options. You need to click on historical data. Yes, Vadim.
I think we cannot see what you're doing in the somewhere.
Okay,
We
let
can
me
see we
share.
can see the project file only.
So let's say for Tesla, you click on the left-hand side on historical data. Here you have the historical data for Tesla. I need the data over the past 5 years, so I'm gonna click on 5 years. And for the frequency, I'm gonna choose monthly. In the past, you could directly download the data by clicking on download. Now it also needs subscription. So what you can do is to select the data and to paste it in Excel. So you go here all the way to December 1st, 2020. So I'm gonna copy this data and paste it in a new Excel file. And here you can change the paste options. So let me share the Excel file. Okay. So now here I have for each month, of course, November, it shows twice, like November 1st and November 19th. Here you can see I have the open price, the high price, low price, and the closing price for the stock. So those, however, are for the month. So for example, if I take the month of October 2025, at the beginning of the month, the stock price was 443.8. At the end of the month, it was 456.56. And during the month of October, this was the range for Tesla. The lowest price, 411.45. The maximum price during that month was 470.75. Then you can see the adjusted close and the volume of trading. What I need from this data is only the date and the adjusted close. The difference between the close and the adjusted close, you're gonna see here that for most of the time, I have exactly the same value. So 402.34, 402.34, 401.25, 401.25. The adjusted close adjusts the stock price for paid dividends and for stock splits or reverse stock splits. Because if you don't have an adjustment and the company had a 2-to-1 stock split, based on the price on closing prices, I would see that the stock price has dropped by around 50%. So maybe it's not the case. So that's why we add a new variable for the closing price and we call it adjusted close. The same when dividends are paid. So to adjust for drops in the stock price due to dividends paid, we use the adjusted close. So mainly when I'm tracking the performance of the stock over time, I should always rely on the adjusted close and not on the closing price. So I'm gonna delete those columns. One of the things that you can do, it depends on when you're gonna download the data. Let's say if you're downloading the data by the end of this week or next week, you can keep this month here, like, because so far I have 19 days of data or 18 days. After a week, it's like it's gonna be almost a month. So it's up to you. For me now, I'm gonna delete this, but for you, you can keep it. And the other thing is that in order to estimate beta, you're gonna need 60 observations for the return. And to have 60 observations for the return, you're gonna need 61 observations for the prices. So I start by computing the return of Tesla. I'm gonna call this return of Tesla. So this is equal to 401.25, the price in November, divided by the price on October 1st, minus 1. So as you can see here, I have a drop by 12% during that month. I will drag the formula down till the end, but I'm gonna skip the first month because I cannot compute the return for December 2020 because I didn't have the price in the previous year. So as you can see so far, and here let me check something. So I'm gonna delete this cell, August 25th, 2022. Sometimes when you download the stock prices, let's say there are splits, which is the case of Tesla, you're gonna see like additional rows. You need to delete those rows. So you need to check that you are having only the monthly observations and that those observations are only for the prices. So this will reduce my observations to 59 observations for the return instead of 60. For you, as I said, you can keep the current month. So this would bring you to exactly 60 observations. After computing the return of Tesla, I need to compute the return on the market. So for this example, I'm gonna use, let's say the SPY. So I'm gonna have the price of the SPY, and I'm gonna later on compute the return on the SPY. So I'm gonna go back to Yahoo Finance. And I'm gonna use this time SPY. So SPY is gonna be my proxy for the market. I click once again on historical data. And I'm gonna follow exactly the same steps, meaning I need to choose 5 years of historical data. So here I'm gonna click and choose 5 years. And of course, you can choose the start date and end date if you want, but you can easily choose 5 years here. I'm gonna use monthly instead of daily. So you click on it and you choose monthly. So once you have the monthly data, you can choose it, like select the data. However, this time you need to be more careful because you have quarterly dividends. So you need to delete many observations. So I'm gonna copy this and go back to Excel. I'm gonna have a different worksheet. So I've pasted the data. Then I need to clean the sample from dividends paid. So I need to select all the rows containing the dividends. So I still have a few. So after cleaning the sample from dividends observations, I need to keep the date and the adjusted close. And to keep things consistent, I will delete the first observation for November 19, 2025. Then I choose those cells, the adjusted close for the SPY, and I'm gonna paste those values here. So this is like the price for the SPY. For the return of the SPY, which is gonna be the market return, RM, I'm gonna compute it the same way as I did with Tesla. So it's equal to 660.08 divided by 682.06 minus 1. So negative 3%. Then I would drag the formula down. Till I get to January 1st, 2021, because as I've said earlier, you cannot compute the return for December if you don't have the price in November. So you need to do this for each stock, and in addition, you need to do this for the market. In your case, you're going to be using the VTI instead of the SPY. What you need to do next is the risk-free rate. For the project, you're going to have, so let me show you here what you're going to get. So if you go back to Finance Yahoo, and here you put the IRX, you can see 13-week treasury bill. So I'm going to choose it. So what I have here, this is not the price for the US treasury bill. This is the annual yield on this specific day for the 13-week US treasury bills. So even if you look into, let's say, over the last 5 years, you can see here when the Fed increased significant interest rates, then they were flat for a while before starting to go down. So those are not prices, those are the actual yields, the annual yields on the 13-week US Treasury bill. We're going to use the 13-week Treasury bill as our proxy for the risk-free asset. You click on historical data. and you will need to download the data for the treasury bills. I'm not gonna do this now, but I'm gonna highlight that you need to be careful when dealing with it because the values, they are not represented as percentages or in their decimal form. So when you have 3.763, it's actually 0.03763 or 3.763%. So all the values that show up here, so after here you choose 5 years, monthly, those values, they're gonna be annual. You're gonna use the adjusted close, and you're gonna transform those values into monthly interest rates. You start by dividing those values by 100. For the first one, you're gonna have 0.03763. You add 1 to it, so you have 1 plus RI, 1 plus the annual rate. You raise it to the power 1 divided by 12 minus 1. This would give you the monthly risk-free rate. So be careful that this is what you should be doing regarding the risk-free rate. Here, I'm going to assume that the risk-free rate is, let's say, 0.2%. So this is not correct. It's not the actual value here. I'm assuming that this is the value for all the months. In your case, there's going to be different rates. Rates can be as low as zero, close to 0%, and the highest can be around like 0.4% a month. Then you need to compute the risk premium. So you need to compute the risk premium on the stock, which is RI minus RF, the market risk premium, which is RM minus RF. So the return of Tesla, this is the return of stock. This is RI. I'm going to compute RI minus RF. So this is equal to negative 12.11% minus 0.2%. I'm going to drag this formula till the end. For the market risk premium, I'm going to do exactly the same thing. So I'm going to have RM minus RF. So this is equal to the return on the market, negative 3.22% minus 0.2%. So negative 3.42%, this is the market risk premium. So once I have RI minus RF and RM minus RF, I have all the variables needed for the regression analysis. Because here mainly RI minus RF is my dependent variable Y, and the market risk premium is my independent variable X. So I'm gonna use regression analysis to find the relationship between the return on the stock, the risk premium on the stock, based on the market risk premium. I'm gonna see how the stock return moves with the market return. So in this case, it's like I'm gonna have the following. I'm gonna have, this is like the equation of the line. I'm gonna have A plus BX. This is mainly the form of a straight line. Y is a function of X, A is the intercept, B is the slope of the line. In my regression analysis, I'm going to have estimated values. So I'm going to have Y is equal to alpha plus beta times X plus another term. Because mainly it's not going to be a straightforward relationship like all of the observations are gonna fit on that straight line. I'm gonna have observations all over the place, and I'm trying to find the best fit straight line that would fit the data the best. And as I've said before, the distance or the deviation between each observation and the line, if I square that deviation and I add up those squared deviation, I would have the minimum squared deviation. So the best fit line is the line that would lead to the lowest sum of the squared deviations from the line. So this part was included in part one. You had to add solver, and while adding solver, I recommended that you also add data analysis because we need data analysis for the regression part. So when you click on data, you have here to the right data analysis. You click on it. You can see different analysis tools that you can use. What I'm gonna use in this case is regression. So you choose regression. I click on OK. Then here I have to input Y range variables and X range variables. So for Y, I'm gonna choose all of those values starting with 12.31% till the end. For X, I'm gonna use the monthly observations for the market risk premium. So I start with negative 3.42%. If I had included the cells with the labels, I need to click on labels. So the regression analysis won't include the first values on that first row. Here I didn't choose RI minus RF and RM minus RF, so I don't need to click on labels. What I'm gonna choose also is the line fit plots. So I'm gonna select this one. I'm gonna click on OK. So this is mainly the result of my regression analysis. And here I'm performing a simple regression analysis where I have only one variable and where I'm assuming that the relationship between the variables is a linear relationship. So as you can see, each of those dots, those are the actual values. So here I have Y and X. So for the values of Y, you can see that for a given month, for example, uh, I have 5.76%, 37.95% for Tesla. And another month, I had the market return or the market risk premium was 9.48%. Tesla's return was 32.18%. If I look into this observation, the market return was negative 6.39%. Tesla's return was 36.93%. And this is after deducting the risk-free rate. Of course, here we're talking about risk premiums. Those values on those orange dots, those are going to form the best fit line. So those are the predicted values. And this line is chosen in a way to minimize the squared distance between each actual value and each predicted value. And as you can see here for Tesla, I have a very high level of variability relative to the market. So here, when I consider now the regression results, if I consider first this value that I have here are squared, the value here can have a maximum value of 1. So according to the CAPM, the only factor that should determine securities returns is mainly the market risk premium. Here I see like some evidence against that proposition that uh, stock returns are only explained by the market risk premium by the systematic risk. Because R squared tell me what percentage of variability in the value of Y is explained by variability in the value of X. So in this case, only 21.5% of the variability in the value of Y are explained by the systematic risk, are explained by X. The higher this value here, the more the return of the security is determined by the return of the market, by the market risk premium. The lower the value, this means that the other component, which is the firm-specific risk, because in this case, 21.5% are explained by systematic risk, the remaining 78.5% are explained by firm-specific risk and other risk factors that I didn't include in this model. Other values that you need to consider, here you have the intercept and you have beta. For the intercept, this is the value of alpha. And in investment, we are always looking for securities with a positive alpha, given that this value is significant. In order to determine whether this value is significant or not, I can look at those two values, T-stat and p-value. Of course, for many of you, you have taken business statistics and you know like about the different confidence levels, like 1%, 5%, 10%. The lower the confidence level that I have, the higher the significance. But like we can take it as a rule of thumb, if T-stat is greater than 2, then I can say that the results are significant without getting into whether at the 1% level, 5%, or 10% level. For p-value, the lower the p-value, the higher the significance. So if this value here is 0.09, this means that this coefficient is statistically significant at the 10% level. If it's 0.045 at the 5%, and if it's less than 1%, it means that it's significant at the 1% level, which is the highest level of significance. Of course, as you can see, T-stat is less than 2, p-value is greater than 10% or 5% or 1%. So I can say that this coefficient here, this alpha coefficient, is not statistically significant and it's not statistically different than 0, whether this value is positive or negative. The other value that I care about is the coefficient of x. The coefficient of x is 1.806. This is beta of the security. So this is beta of Tesla. So for beta of Tesla, I can say that this beta is statistically significant because the value here, 3.95, is greater than 2. The p-value is less than 0.01, so it's highly significant. Let's consider another security. So if I want to consider another security that's less volatile than Tesla, let's say this time I want to conduct the regression analysis on Walmart. So I'm going to go back to Yahoo Finance. Or I'm going to choose another company that's not that volatile. Let's say I'm going to choose Procter and Gamble. So once again, historical data. So I'm gonna choose monthly and for the last 5 years. So it seems I'm having some connection issues. It's taking much longer than it should take. So here, while waiting for the page to load, or what I wanted to show you through adding Procter and Gamble, or to add another company with lower volatility, to show you how this is gonna show on that graph, and how it's gonna also be reflected through data. So now I have the values that I needed. Now it seems the issue is with my laptop. Okay, hopefully it works this time. So I'm trying to copy the data. So I'm gonna go back to the Excel file. I'm gonna have a new worksheet. I'm gonna paste the data, and I'm gonna move the columns that I don't need, and the rows containing the dividends. I need also to remove those, because Procter and Gamble pays a quarterly dividend, so I need to remove around 20 observations. So we're done with removing those cells. What I can do next is that I can go to the main worksheet that I had, the one here. I'm gonna copy it and paste it on a completely new worksheet. And then I'm gonna copy the values for Procter and Gamble and paste those here in place of the price of Tesla. So this time I have the price, and here one more thing I forgot to do is that I need to remove this observation 19 November 2025 before copying those values. So once you do this, all the values are automatically updated. Of course, now I'm talking about Procter and Gamble. So this is the return of Procter and Gamble, and so on. So let's see quickly what would be the regression results. So I'm gonna again go to data, and I'm gonna choose data analysis. So regression. Then for the cells, they're still the same. So for Y, I have the values of Ri minus Rf. For X, I have the values for the market risk premium. I still have the same selections for the line fit plots. Then I click on OK. And the results of this new regression are generated on another worksheet. I was hoping to see something with less volatility. It turned out it's even with the higher volatility, meaning although like the stock, Procter and Gamble is not as volatile as Tesla, but it has an R squared of 11.26%, meaning that the market risk premium explains better the returns on Tesla than it explains the returns on Procter and Gamble. You can see for Procter and Gamble, it has a very low beta relative to Tesla. It's 0.382. For Tesla, it was 1.8. So on average, when the market moves by 1%, Tesla moves by 1.8%, while Procter and Gamble would move only by 0.38%. And for that reason, you would prefer to have a higher beta portfolio when the market is up and a lower beta portfolio when the market is down.